Welcome back, ladies and gentlemen, to the Sustainability Summit Week 2020. If you've just joined us, I'm a bit worried because you missed out on a jam-packed program. However, we are back with more, leading us again into discussions around funding sustainable infrastructure, project bonds, green infrastructure bonds, transformation bonds, as well as the green climate funds, is once again Mr. Brandon Abedner, who's an attorney, consultant, and co-founder of Climate Risk Clinic. Please don't forget to hashtag SAS Summit 2020. That is hashtag SAS Summit 2020. Add your inputs, comments, and we are more than happy to hear from you. Don't forget to visit our 3D Expo exhibition. Ask questions because you're going to stand a chance to win impeccable prizes. Without further ado, ladies and gentlemen, let us welcome Mr. Brandon Abedner, who will also introduce his accompanying panelists. Thank you very much. Over to you, Brandon.
Thank you, Tabang. Hi, everybody. It's good to be here. We've got a relatively small panel, but I think it's going to be quite a dynamic discussion. One of the main reasons being that it's around fundamentally money. And money makes the world go round, or money makes the world come to a grinding halt, depending on how you look at it. So I'm very happy to welcome the panelists, and I would like to ask you to all please introduce yourselves. So if you just say a little bit about who you are, what experience you have, and how the work that you do interacts with the topic at hand. So going down my list, if we can start with Patrick, please.
It's great to be with you. Thanks, Brandon, and all our colleagues. I'm originally from Northern Ireland, and I'm based now at the University of the Western Cape. You know, in between, I did work in the financial markets. I was a regulator at the US Federal Reserve, what we call a captive regulator, because they basically served global financial interests, especially in this chaotic time where South Africa had its first big debt crisis, 1985. And so in my experience, working from within the system has been frustrating, except where there's a bit of, let's say, volatility, like the end of apartheid in part because of financial sanctions. And so I come to climate finance politics with a skeptical perspective and a commitment, instead of insider reform and financial innovation, instead to much stronger state regulation driven by activists. So that's my bias.
Thank you, Patrick. Kate. Kate, you're on mute.
Sorry.
No worries.
I'm Kate Strawn. I'm a senior professional officer at ICLEI Africa. I work in the climate change, energy, and resilience workstream. My background is actually coastal science and climate change. But at ICLEI Africa, we serve African members in more than 25 countries across the continent. We have a staff of about 50 at our African office. We initiate peer exchanges, partnerships, capacity building, workshops, and work with local governments on technical issues around climate change. One of our focuses at ICLEI Africa currently is looking at financing for change, and in doing so, responding to the growing acknowledgement worldwide that in order to tackle climate change, city-scale finance must be mobilized, and local finance will give subnational governments access to resources they need to respond effectively to climate change and the impacts associated with that. And then, I think how I come into this is currently I'm working on a project called Urban Natural Assets Coast for Life. And part of this project, we're exploring funding mechanisms that can be harnessed to invest in climate adaptation projects that build resilience against these natural hazards.
Super. Thank you, Kate. Sinagugu, welcome. And I wonder if you could introduce yourself and just place yourself in this conversation, please. Seem to have a sound issue, but is not muted on the Zoom. Sinagugu, we can't hear you. Can anyone else hear him? Sinagugu, are you muted somehow on your side anyway? Because you don't seem to be muted on Zoom. Okay, I wonder if the tech people can just take a look at that, please. And let's just move on to Dean until we sort Sinegugu out. Dean, if you could introduce yourself, please.
Sure. Thanks, Brendan. Hi, everyone. It's great to be part of the panel. So my name is Dean Albra. I lead the environmental, social, and governance practice at Old Mutual Alternative Investments. Old Mutual Alternatives is made up of 4 main businesses at the moment. It's a fund of funds business that invests internationally in other private equity fund managers. There's a private equity business. We have an impact investing business and then a specific infrastructure business. And I think that's probably where most of my linking to this conversation comes in, is around financing sustainable infrastructure. Great to be part of it.
Super, great to have you here, Dean. Thank you. Sinegugu, can we try again, see if we can hear you? We can see you, but we can't hear you. Oh dear. Okay. I wonder if, yeah, as I said, if the team can maybe keep working with him and see if we can get something on stream there. Okay, so let's continue until that hopefully gets sorted out. So I think we can have a very organic discussion around here. I mean, I've got some pre-thought out questions, which I may direct at one or more of you, depending on the context. But I very much encourage that everyone jumps in as they see fit in terms of the discussion on the table at the time. You can just raise your hands as well, and I can then recognize you. So the topic talks about green infrastructure bonds, transition bonds, etc., etc. What are these instruments exactly, and how do they differ from more traditional financial instruments?
So in my direct line of business, we have some touch on green climate bond space, but essentially, you know, it's a debt instrument where there's specific requirements around the bond to meet certain standards, and those standards can be there are multiple standards out there at the moment already. And you know, the green bond is specifically looking to achieve capital deployment into green outcomes. So typically what's thought of here as the green economy, which is socially inclusive and low carbon, socially inclusive and low carbon economy. So any financing that's going into businesses or ventures that drive that outcome. Transition bonds typically are thought of as a bit of a broader category. In other words, you're looking to transition from one state of an economy to another. And so it may include investments that don't strictly fall into the green bond standards and categorization and guidelines. So it's a bit broader. And then social bonds, again, you're looking for specific social outcomes against standards and guidelines for that debt instrument. And so, and the climate, green bonds, sustainability bonds, social bond space has been growing very rapidly over the last few years as a, you know, as a space to raise capital in the debt markets. Yeah, so I think, and it's, for me, you know, looking at it, one of the questions I got asked, just to end off on this point, one of the questions I got asked recently in a limited partners discussion was, you know, should green or sustainability outcomes sit primarily on the debt side, or should it rather sit around the equity side of the equation, where you have more direct influence around businesses to drive a green outcome? And my position on this at the moment is actually we should be looking at this as a whole financial system question. And if we want an entire financial system that shifts and drives us towards a more sustainable future, then actually we need all levels of the financial system engaged with green climate type outcomes. So I think having, you know, the bond market fully engaged in this is a great outcome for us. Thanks.
Super. Can I just follow up with a follow on there? So you said there's been a lot of growth in that particular sector, what do you think has driven the growth in demand for more green financing instruments?
I think what we're seeing is global trends around what is acceptable and palatable to the end investor on the street. In other words, where they want their money to end up and how they want it to be used. I think that's driving a lot of the big institutional investors into looking at sustainable outcomes as they try and meet the expectations of the younger generations coming through and the expectations of that. I think we're also seeing at a regulatory level, governments around the world rapidly shifting their focus into the green economy and, pushing down more stringent requirements in terms of outcomes of where capital is getting put to work. So I think those two kind of big movements and shifts are what are driving some of this look into the green bond market.
Okay, super, thank you. Sinaguga, apparently you've been sorted out sound-wise, so can we try again? And if you could introduce yourself, please. Okay, I'm having problems hearing still. Can anyone else hear Sinaguga? Okay, I know he's probably in the Eastern Cape at this point in time, and the connectivity is a bit of an issue. So we'll keep trying to get him on board, but he is listening. And the organizers have told me that he will be recorded giving his response to the discussions as well. So if we don't get him onto the actual talk, we will be able to make his thoughts available after the fact. Kate, can you maybe elaborate a bit on how your work with ICLEI interacts, if you like, with the green financing side of things?
So yes, as I mentioned, one of the things we look at is local finance and how subnational governments and local governments are able to access finance in order to respond effectively to climate change impacts at a local level, and harness the emission reduction potential for cities. So looking at alternative mechanisms, looking at the fact that we can't always rely on the traditional mechanisms for financing. So one of the ways is looking at the bond market and how that can be utilized, especially with regards to financing climate adaptation and resilience, which is something that really needs to be taken into consideration at a city scale on the African continent. And also looking at how we can mix different finance mechanisms together in order to finance city infrastructure and as well as climate adaptation and resilience.
Mm. And do the advent of these instruments or products make it a lot easier for you to do that now?
As the topic of adaptation and resilience is becoming more known, people are more susceptible to looking at these alternative financing mechanisms. I think especially now with your nationally determined contributions coming into play on the African continent, I think we're looking at different ways in which we can finance elements of that. So I think definitely.
Great. Thank you. Patrick, Ian spoke about the whole financial system needing to move into green space, so rather than it being an offshoot or a new kid on the block, we actually need to be thinking in these terms very much holistically. What are your views on that?
Well, I would put to my dear colleagues that this is very dangerous, because anytime financiers turn their attention to something, it's for one simple reason: profit. And if activists are pushing divestment, then I can certainly understand why major banks, I mean, we just had Habametsi, the big coal-fired power plant proposed by a Korean-Japanese consortium, undermined by the lack of financing due to activism, right? So all respect to Sinaguga, the other activists out there doing this. But nevertheless, if you think that, let's say Nick Stern, right, the great theorist of this strategy of green bonds and green finance and using market solutions, his idea is that the climate catastrophe is the world's greatest ever market problem. And the typical economist perspective is you solve a market problem with a market solution by internalizing the externality. And there's no better force for doing that than financiers, because they have rapid scope of vision, extraordinary capacity to act, socio-political power that's unprecedented. And yet, the dangers, I would put, is that it's not necessarily a market problem, but a market system problem, and that the broader crises of our world economy, so acutely felt in the financial markets this century, right? From the big dot-com crash of 2000, that was a great trendy moment. The real estate investments, especially in the US, that brought us into the 2008-9 world financial meltdown. And then the rise and fall of carbon markets, right? The climate strategy of the Kyoto Protocol and of Al Gore, it rose, and then the Chicago Exchange completely crashed. The EU emissions trading scheme went from 35 euros a ton of carbon down to 3 euros. It's now closer to 30, but because of regulatory pressure. And so I put it to my colleagues that there's volatility. There's also fraudulent double counting and the, let's call it, inability to really calculate carbon sequestration that you can pay for with new financial instruments. And third, there's just outright corruption, volatility, the ecological fraud, and the corruption and the lack of regulation, frankly. And in our own case, I'd add a fourth, that we have very high prices for financial market instruments, because if you look at the world market for any state-issued bond, we're number 3 after Turkey and Pakistan. We're paying an exceptional premium. We're paying about 9% on state bonds, far higher than we should, because I don't think there's anybody thinking that the ANC government's going to default on loans. And then the ability to raise the funds to make the kind of transitions that we need so desperately, from carbonized and high emissions activities to decarbonized, low emissions economic activities. The rates of return are negative, right? When you've got very low prices in the global markets for especially the offsets in the carbon markets. Now, Dean mentions it's changing. Yeah, Joe Biden and especially John Kerry as his climate czar, the EU pushing the price up. And Google a couple of months ago saying they're going to try for carbon neutrality by buying offsets. All of these mean we're going to see some pressure upwards on prices, which is good. But let's be frank, we're playing with China at $6 a ton. The best system is California in the West, which is about $15 a ton. And then Europe, which has been driven up. It's so far below what we really need, which is in the $80 to $100 a ton. Sweden has a carbon tax of $132 a ton. But I have no confidence that the carbon markets will allow this to happen. Just in one sentence, if you think you can solve the world's greatest ever crisis, the climate crisis, by giving this problem to financial markets, when the financiers can't even sort themselves out, we go through massive ups and downs, then you're mad. It's a challenge to my dear colleagues.
Thank you, Patrick. Yeah, I think I definitely want to keep this thread going, but I've been asked one more time to try Sinegugu, who's now possibly not going to have his camera on. Sinegugu, can we see if we can hear you? Okay, I don't think that's working, unfortunately. Okay, Dean, how would you respond to what Patrick has just said? Do you see the financiers actually being a viable and effective mechanism by which the climate crisis can be addressed?
So I think that in part, yes, I do. I agree with Patrick in the sense that they cannot be the only solution. Absolutely. One cannot look at financiers and say, right, the financial system globally needs to be responsible primarily entirely for solving sustainability across the globe. I do think, though, that as one of the actors, the financial system is a key actor in influencing and directing what happens globally in terms of sustainability. And so I think one certainly wants the financial system globally to be aligned with a more sustainable future than not. Having said that, I absolutely agree that there's danger in trying to socially engineer an outcome out of our financial system. And I think a financial system still has to stick to the core principles of what it is there to do, which is to create wealth, to govern money flows, and to make returns. So, for example, if we just take the pure example of a bond, I agree with Patrick in the sense that one still has to first and foremost look at this as an investment instrument. And does it make sense, first and foremost, as an investment instrument? And if it doesn't, then one shouldn't be trying to socially engineer this thing into something that actually it's not fit to do that. And I think that's how, financiers should view it, is that first and foremost, these are financial instruments and they need to make sense for the instrument that they are, and they need to serve that purpose. If one then has a choice of alternatives that you can invest in, and you can invest in something that is more responsible, then we should be aligning along guidelines where we should be investing responsibly. So I think that's maybe a nuance there that's important. The other thing is to maybe highlight as well and just throw out there that talking about issues of volatility, ecological fraud, lack of regulation and corruption, these are things that don't just occur on the green side of issues. These occur in the financial system on all kinds of issues that are already existing in the mix of the ecosystem of the financial world. So, to be honest, one is inherently playing with those issues anywhere in the financial system, whether it's a green issue or whether it's some other kind of issue that you're dealing with. So I think those will always be there. And we do need to, and I agree with Patrick in the sense that there needs to be strong regulation on this, so that we, as best as possible, make sure that any instruments that are dealt with in this green economy type space is as best as they can be in terms of regulation and cleaning out any kind of corruption and what have you. So I agree on that, but I think it's important to point out that it exists across all kinds of issues in the financial system. So I think the other thing is to say, on the one hand, it's dangerous to socially engineer and to not regulate and to not understand and highlight that there are these ecological issues. But at the same time, one could throw the question out and say, well, from a sustainability perspective, is it not also dangerous to purely target return? So if you go completely on the other side of it and you say, well, actually, if we say that the financial world and financiers must only 100% target pure bottom line return, I think history has shown us that that doesn't really work either. Hence, the growing concept of shared value, and where, yes, there needs to be return, but in the context of responsible shared value for a future for us all.
Great. Thanks, Dean. Kate, if I can come to you. In terms of adaptation, the adaptation measures that you need financing for, when it comes to looking at that through an infrastructure lens, where is our infrastructure at in terms of being adaptable to climate change, and where does it need to go? What paths do we need to stop going down infrastructure-wise, and which new paths do we need to start walking down?
I think, research reveals that sustainable infrastructure can only be developed and delivered if there's three pillars that are sort of all coincide with each other, and that is economic, environmental, and social, that are all considered together when we ensuring that infrastructure is sustainable. And I think this is something that is not always taken into consideration. I think we look at it and we think, well, it meets the economic. We speak to economic, and that it's providing jobs, and it's there's maintenance involved, and it's connecting communities to cities and education, and that's employment, that sort of thing. But then we don't always look at, for example, protecting the environment. Like what part does this infrastructure play in conserving natural resources and reducing the impact of climate change? So clean energy plants, for example, are critical in reducing the dependence on fossil fuels. By taking cars off the road, mass transit systems can contribute to the reduction of pollution and the generation of greenhouse gases. And then from an equitable side of it, Society benefits from infrastructure in itself, since it delivers the services such as power supplies, health services, sewage networks, those sort of things that are essential for sustainable development, whether they're providing public transport that makes it easier for women to get from rural areas to cities. But yeah, so I think the only way that we can ensure that infrastructure is sustainable is if that it talks to both economic benefits, environmental benefits, and equitable benefits, but also society benefits. So yeah, I think there's definitely three pillars that need to be taken into consideration, not just, for example, the economic side of it, but also the environmental side and the societal side. And then I guess speaking to the sustainable development goals in doing so.
Super. Yeah, thanks, Kate. Patrick, you have been known to say on a number of occasions that, or suggest that perhaps there should be more liability on the parts of financiers for the projects they finance. And one example that comes up is the World Bank in relation to its loans for the construction of the Medupi power station. Could you say a bit more about that?
This is exactly the right line of questioning. I'd love to hear if Dean and Kate would agree with me that we cannot continue to allow the financiers of corruption, blatant corruption. And in the case, I'm sure everyone's heard of on October 22nd, the assassination in Chingazi. And the World Bank was also the original catalytic funder for the company called Petmin in its Tendele mine in northern KZN. And they made a 39% rate of return on the new Africa Mining Fund investment that the World Bank put $5 million into. So, more than $10 million. A reparations by the bank for not just the big one, right? That's the biggest loan they ever made, Brandon, $3.75 billion for Medupi. Now, they knew Robert Zoellick was the president. We had lots of talks with him in 2010, because at the time, Hitachi had bribed the African National Congress, environmental leader, but he was the chair of ESCOM, and on the ANC Finance Committee, the public protector said he acted improperly. Now, that kind of corruption, Dean, Kate, agree with me, they must be punished. Odious debt, in that case, is so explicit. And the fact that not just the World Bank, but the African Development Bank, KfW, the big German bank, the French bank, DBSA, our own often quite corrupt local development bank, and then the BRICS Bank also funded Medupi, and now we have Kusile, funded by the China Development Bank, plus private financiers. Really, all of us who are electricity consumers should be asking. They knew early on, right, from 2009, that, as the public protector said, Vali Musa acted improperly with a conflict of interest in making sure that the tender went to Hitachi. They needed to do 7,000 new wells because this was a very incompetent boilermaker. Why are we paying the vast markups on Medupi and Kusile electricity? Why are Dorpies being shut off all over South Africa with catastrophic results? Why are big chunks of Soweto being load reduction victims? And it's because of these very high prices, ESCOM charges, and the loan at $3.75 billion. What is that? Over 50 billion rand. Really should be questioned. If we had a finance minister and a Reserve Bank governor who were concerned about corruption rather than nudge, nudge, wink, wink, and we had a society that was better informed, we'd be up in arms about paying these corrupt financiers. Please agree with me, Dean and Kate. Before you take more green bond finance from these guys, make sure that they're paying reparations for the corrupt financing they've been involved in. Corrupt also because it's climate catastrophic in the case of the Petmin Tendele coal mine, in the case of the Medupi power plant, in the case of the World Bank, and we could go on with plenty of other examples. Please join us, because I think we need to get this up and running. An odious debt, a Jubilee campaign to say that's unjust debt, and the financiers involved in that should have written that off and taken the haircut on it instead of ordinary poor people.
Dean, do you think financiers are taking enough responsibility? I mean, we are seeing moves. We see the TCFD, for example. We see a lot of banks starting to embrace climate change as something to be addressed. And I obviously don't need you to speak about your competitors or name names, but despite these moves and sort of attempts to clean up the image. We're obviously seeing these very carbon intensive projects still being financed. What are your feelings on where the evolution of that sense of responsibility is, and do you think it's going to get to a point as meaningful as, for example, Patrick would like it to be?
Sure. Look, I agree with Patrick in the in the sense that absolutely there has to be accountability, and I think one of the biggest challenges we face, in Africa specifically as an emerging market, is around governance. It's more internationally, it's a big question on our whole investment landscape, and it's something that we need to focus on and make sure that we are better at. And I think one of the challenges we face with this is the transparency in the value chain of investments. So, if one follows the capital, it ends up going through many, many layers of investments. From a project site on the ground, whether it's either through the equity or debt financing, instruments, layers and layers and layers up, and in each layer, there should be, and what we need to try and work towards is really clear, transparent governance. Those forums at each level have absolute clarity on why decisions are made and who made them, so that when something does go wrong, one can go to the actual forum, the governance forum, and understand it was at that level in the capital value chain that these decisions were made, and there can be accountability at the right level. I think one of the challenges we face is where that governance chain is not clear enough, then it becomes a little bit murky of where does the responsibility lie. So in other words, and obviously a key question is the ultimate top line investor, the big institutional players often get looked at and said, well, can you not see what's happening, with this, and there's corruption taking place, or you're not responsible. And a key point of view for them, I think, needs to be how clear is their line of sight on that actual project on the ground. Do they, from right as a top financier, have a very clean line of sight? Now, I think many times we face a situation where that's not the case, especially when you're going through multiple different funds of investment. And so I think the first thing that we do need to do is get far better at this governance chain from the way decisions are made. And I think where that becomes transparent, and then if it's challenged, it can then be viewed and said, okay, we know where the issue is, we know where these decisions were made. So, and then it is easier also to hold ultimate financiers responsible, because they then should have a clear line of sight down to the investment on the ground. I think in terms of the kind of second part of the question here around, shifting fossil fuel base and things like this, and where does that happen? I think that's a complicated question in terms of energy mixes and where we sit and who the players are involved with that between government and private sector. Look, the broad idea is, yes, we need to move off fossil fuels. I don't think that's really a question. The question is how, and how fast can we do it, and how do we do it in a way that we protect the most vulnerable in our population. So that's really what we need to grapple with. And I think the private sector does have a part to play in it, because if you look at the current state balance sheets, there's not enough capital of state balance sheets in our region to actually achieve this. So there has to be a public-private interchange, and the private sector, I think, has to be part of the solution. They don't necessarily need to determine the solution, but I think they need to be prepared to be involved and be able to support. I think and in some ways, having the private sector in with the public sector can create a healthy environment of transparency. In other words, if it is only private sector doing it, would there be the same level of transparency from the public on what is happening and the decisions made around the fossil fuel trajectory? If it was only government doing it, would there be the same kind of transparency and look in? Whereas I think when you have more players involved, there's a healthy kind of view in on the governance side of why decisions are being made. I mean, at the moment, we've got an IRP, an updated IRP from 2019 for South Africa specifically. We also know that 2020 has been a year of huge economic impacts. And so the big question is, can we as a country, given what's happened in 2020 and our current economic status, still meet our obligations under the IRP as they were envisaged and planned out in the IRP in 2019?
Thanks, Dean. Kate, ICLEI is obviously a global organization, or has got a large global footprint. Are you aware of how South Africa ranks in terms of being able to access the kind of finance that you need compared to other countries? Are we relatively progressive? Are other places finding it easier to do that? And I don't know if that's something that you perhaps know.
I'll comment on that very much. I think from an infrastructure point and investment that's in South Africa, I think we have greater access to finance. But I think that is changing in Africa. I mean, I only work on the African continent. But I think it is changing, and I think we're seeing a shift in where finance is flowing slowly. I think there's still a struggle on the African continent, especially with the fact that so many governments are centralized. And as such, a lot of finance needs to flow through national government before it reaches local government for implementation, which I think in itself is a challenge. I think we need to see a change in that fact that we need to see finance flow directly to local government instead of through national government to ensure that there's implementation on the ground. And I think there's a greater need on the African continent for public-private partnerships. I think it's in a way ensuring that there's transparency and that there's finances flowing correctly to implementation projects. But yeah, I can't really comment on that.
Okay, and then just to follow on from what you've just said, in your opinion, is local government sufficiently capacitated to play its role at this point in time in terms of adaptation projects?
I don't think all of them are, but I think there's a lot of growth happening at a local level. I think we're seeing local governments becoming more involved in decision making, and I think they're becoming capacitated to be able to take on this role. I think there's still need for growth. I mean, a lot of because finance has flowed through national government, our local governments don't have the capacity to be able to manage funds and the amount that's needed on the ground. I think that's where, it's important that we look for alternative finance mechanisms so that our local governments can manage such projects and be involved in it, and that's not necessary to flow through national government. And there is a need to capacitate our local governments. I think there's huge potential for them to take on this role. But I think in many African countries, they're not quite there yet, but there's definitely growth towards that. And I think, as I said, looking at alternative financial mechanisms will enable our local governments to take on this role.
Thank you. Patrick, in my experience, a lot of the kind of transformation that we are seeing, whether it's very deep or not, including in the financial sector, a lot of it that is driven by the Paris Agreement. Despite the fact that it's not binding, despite the fact that pretty much every country besides Morocco is performing quite woefully. And we know the COP last year didn't go very well, and obviously Trump wanting to pull out wasn't good, but with Biden coming back in, do you see that the Paris Agreement strengthening, and do you see it exerting the kind of pressure for transformation that we need?
I'll be really frank with you. I see the Paris Agreement the way that the greatest climate scientist, James Hansen, does. He has one word to describe the Paris Climate Agreement: BS, right? That word reflects that there's no binding emissions, unlike the Kyoto Protocol. no accountability system. So when Donald Trump pulled out, did we have carbon taxes and sanctions? No, it wasn't even raised except by Joseph Stiglitz, Naomi Klein, and some dissidents. There's no, as a result, there's no penalty built in. So it's a bottom-up Orwellian language from Barack Obama in 2009 to describe, yeah, we do what we want. And South Africa is one of the worst and just hasn't been penalized. It hasn't dispensed with the failed carbon trading strategies that I mentioned, but it won't accept climate debt. If you believe that the North, including here in South Africa and the wealthier parts, owe the South for the massive damage done, you can't sign the Paris Climate Agreement because you give up liability. There's nothing in the Paris Climate Agreement about the just transition that's required that would allow workers to finally come on side to unite with environmentalists and communities. There's nothing to get rid of the intellectual property restrictions on the renewable energy technologies that the North and China hold very tightly. What does the Paris Climate Agreement say about the military? The #1 polluter in the world being the US Pentagon. What does it say about shipping? What does it say about air transport? Nothing. What does it say about fossil fuel owners needing to leave the resources underground and consider them stranded assets and stop new exploration? Nothing. So in those ways, I think the Paris Climate Agreement is BS. And yes, you're right. It will be strengthened and there's more legitimacy because John Kerry was part and parcel of its revitalization. However, if you're serious about climate, can those fatal flaws be reversed at the UNFCCC level when you have delegations like Pretoria's, right? Our own national delegation going and continually fighting. And when you see them approving willy-nilly oil and gas, a national gas pipeline coming from our own scientists, right? The CSIR. When you see the coal mines expanding, when you see in the Limpopo province, not just the Waterberg digging of coal, 18 billion tons, in the single biggest infrastructure project in the country, right? The 800 billion Presidential Infrastructure Coordinating Commission's Strategic Integrated Project #1, which takes coal from not just the Waterberg, but 200 billion tons. After that, from Botswana through Richards Bay. And finally, we have Messina Mikado, which the government is promoting with a 3,300 megawatt power plant that, Dean, when you talk about the IRP, I just have to laugh. Where is that in the IRP? Why is it going full steam ahead? What the hell is wrong with our ruling class? And I have to answer, really, Kate, when you ask for more PPPs, for more transparency, to me, it sounds like public-private plundering, right? When you get, Dean, you ask for public-private to come together for more transparency and more, integrity. But let's be frank, our government, of course, or least corrupt, or most corrupt government, that is politicians and bureaucrats in the world. You can look at Transparency International Corruption Perception Index from January. But Dean, PwC ranks your people as the second most corrupt corporates in the world. Have you seen the economic crime report of PwC? When we have 17 banks that are up for corruption in currency manipulation, and our government won't touch them, but we have to get them prosecuted in the United States. I just have to ask you, what planet are you on to expect markets to have any responsibility? We've really got to get them out of this space and to get the reparations and the climate debt payments that they need to pay, right, for the damage done. If you really do believe in market solutions, that polluter pays, the Paris Climate Agreement is useless. There's no climate debt there. You have to actually move to the left if you believe in something as simple as polluter pays ideology and turn that against the private sector for the massive pollution that they've caused in this country that hasn't been accounted for yet.
Thank you, Patrick. Dean, Patrick mentioned the just transition. So does the just transition come into the thinking in terms of the kind of products that your sector is dealing with?
Yeah, Brendan, for sure. It's something that we are engaged in with actively, actually. So we're actually undertaking a piece of work now where we're looking at the different energy mixes and representative jurisdictions across the African continent to understand what is a viable, practical solution in helping to shift that energy mix in these representative energy mixes in these jurisdictions. And so one's looking at the, obviously on the one side, adding in as many renewables as you can, into the mix. Then on the other side, if you're looking at the actual fossil fuel spectrum, so starting with the highest coal intensity, carbon intensity emissions, so coal, and then going down to your heavy oils, light oils, down to diesel, and then gas. And so on that spectrum, on a phased approach, can one shift down that spectrum? And what is the timing on that? And how does one do that within the current energy mix that exists as the baseline in that jurisdiction? And I think, as much as one wants to drive as much renewables as quickly as possible, there's also a reality check on the other side saying that the actual utility grids in a country cannot necessarily just handle that immediate switchover. So even if you had the capital, so hypothetically, let's just say, even if you had all the capital and you could deploy it all into renewables, in 1 year, you still have this reality check of saying, okay, but how does the utility going to actually handle that? How's that going to practically function as a power system? And so there's a view on that as well, as how do we shift that as quickly as we can, but still allowing a sustainable power grid and system at play. And I think it comes down, you often hear this term baseload. It's a very loaded term, I know. There are different engineers around the world that have very different views on that and how you can smooth out certain renewables to actually create a baseload effect. A lot of that, although technically possible, is premised on certain kind of grids that are available. And in the African context, those grids don't exist. So, how does one do that, still allowing for a foundation level of power that allows that country to develop economically, so that you're not actually further crippling that country economically. So we definitely fully engaged in this. And, our view is one of, we're working on solutions to drive this as fast as we can, in a sustainable, practical way. And also bearing in mind that we have to bring along with us on that journey workforces that maybe historically have been sitting in a certain sector. And that is a big challenge, absolutely. In our sector, we don't directly invest in coal at all. Our policy doesn't allow that, anymore for some years already. But we recognize that there sits a workforce that we need to be able to transition across. And, I think one of the things specifically in South Africa is, we'll all share in this outcome of a transition in some form. Some of us far more, directly than others, but ultimately, we're all going to share in that transition. And so how do we do that in a way to minimize the negative impact on quite vulnerable populations in our country?
Thanks, Dean. So an aspect of that would be, for example, people who are involved in coal mining jobs. Is the reskilling of a workforce like that even something that is financeable?
I think it is. I think there are institutions that, would be able to look at finance to back that kind of transition program. I've had one or two discussions myself with international players that have shown an interest in that kind of thinking. I think one of the key things, though, that we face here is, I think the capital requirement is one aspect, but another requirement here is speed. Actually, this is something, to be honest, that we should have been doing already, and we should have actually had a program in place already and be quite far down the road on. Given the 2030 kind of view we're having around the climate crisis and where we should be, where we need to try and be, but are actually very far behind on it, as Patrick pointed out. So, this is something we should have been doing already. And, what that's going to mean is possibly what could have been a certain level of capital carried over a few years is now going to need to be more capital driven into a much shorter space of time, I think, to try and effect that transition. And I think it's something that should be absolutely one of the highest priorities in our country right now.
Absolutely. Thank you. Patrick, the kind of activism that places pressure on the financiers to accept responsibility for odious debt, is that successful anywhere else in the world? Have we seen good stories around that? How far down the road is it? Where does it need to go?
Well, yes, absolutely. Just on the general principle of reparations for damage of this sort, we'd always talk about the Kulumani Support Group and Jubilee South Africa winning against General Motors in 2012, their repayment of profits that they made during apartheid to victims of apartheid as an exemplar. A small case, of course, we were very much foiled by Thabo Mbeki, the then president, working against the reparations case. And Penwell Maduna, at one point, the justice minister, actually was the lawyer for the companies, right? And so that went to the US Supreme Court, and at least GM came under the kind of social pressure to repay. For odious debt, I'd say the finest case was when a really genuine president of the people at the time, named Rafael Correa in Ecuador, was able to force the Norwegians to cancel debt, including on oil-related and shipping-related loans. That was chock full of corruption and was unfair. So we have so many good cases of, let's say, an odious debt being declared over the past century. The original legal framing came from, believe it or not, the United States. They wanted to help their new friend Cuba, and this is back against the Spanish in the Cuban original liberation struggle. Not the 1960, 59 Fidel Castro one, but going back to the 1890s, and they began to establish a doctrine of odious debt. So I definitely think odious debt and the questioning of things like the Medupi loan, but more generally, whether a climate debt can be paid. The precedents there are enormous. There is, for example, in the United States, a super fund that takes on massive polluted projects, and it was up to hundreds of billions of dollars to basically repair and then to halt the damage. And I think that's very different than what is stylish in financial markets, which is instead of a fine and a commitment to cease and desist, which is what we'd like to see, a reparations payment for pollution, including greenhouse gas emissions. Instead, we're getting a trend, and I hate to say, Dean and Kate, I think you're part of it, which is for payment for ecosystem services and the right to pollute, that is privatize the air, so you can just go out and buy in various markets and offsets and carbon markets, and maybe green climate bonds will be part of that, the right to continue to pollute. In other words, you just pay to pollute. Instead of a polluter pay, fine, and ban, you just keep doing it, right? And then you take the space away from poorer countries for them ever to have the ability to have greenhouse gas emissions to industrialize. I think it's a completely wrong-headed approach that we're looking at. And I would say it's even worse. I don't know if you'd agree, you play in the JSE. We've had, if you look at the Warren Buffett indicator, I'm sure Dean and Kate know that the Buffett indicator, market capitalization, the GDP, is for South Africa the highest of any country in world history until the 2018 crash of 10 cents and hence Naspers. That is a signal that at least at the peak in 2018 at 60,000, the JSE was massively overvalued. It was a terrible bubble. I don't know if Dean and Kate, you're telling your investors, your friends, go into the JSE, but obviously you wouldn't, right? Because it's a ridiculous casino. It has no correlation to the actual state of the economy. And if so, Dean and Kate, would you not then agree? We have a vast amount, maybe 15 trillion rand in institutional investor funds that's just chasing casino paper profits with corrupt companies. It's time to get prescribed assets and to get our pensions out of that absurd site of financial corruption, the JSE, right? To get it into state investments. Dean initially said, hey, we have a limited fiscal space. We don't, Dean. If you tax corporates at what we were in 1992, do you remember that? Maybe I've got gray hair, I'm a bit older than you. You remember what the corporate tax rate was? It was 52%. What is it today? 28. We've got to go back to a social democratic now green approach that takes corporate taxes seriously, right? And if we have about the 4th highest profit rate in the world of our companies, according to the IMF, you can look at their consultation. It's called the Article 4 consultation. And you find South African companies and banks rank in the top 3 or 4 in the world regularly for profits. And they're taking them out of the country, 400 billion rand a year, according to the Financial Intelligence Center of Treasury, through illicit financial flows. Again, our Treasury and our Reserve Bank is nudge, nudge, wink, wink, let them do it, no problem. That's where we've got to get a clamp down on you guys in the financial markets and get you to behave and not wreck my pension fund, much less the economy, the green potentials in this country. I rest my case. I'm being a bit critical, but if you allow me at some point, Brandon, to give you the best case that I think someone like Kate could make, which is that Durban was not just national and continental, but a world leader in green climate financing. And you look at the 2 mayors involved in Durban solid waste, Zandile Gomedi, and before her, Obed Mlaba. There were a couple in between both of those. But they went down in corruption charges because of their relations with Durban solid waste, including the Bosasa Road methane to electricity landfill project, our first big project on green financing, the clean development mechanism that started in 2004 because Mike Sutcliffe, the city manager, thought, oh, we'll bring in the World Bank instead of keeping our promise to the people of Clairwood in Africa's biggest landfill to close it down because it was a racist dump from the apartheid era. No, we'll keep it going for years and years more with World Bank financing. To me, that's the kind of danger that's not just theoretical. It's not just me being ideological. It's actually what happened. And if you look at the South African Local Government Association report, they will admit that the #1 pilot project we had in this area for municipal green financing, the Bosasa Road landfill in Durban, was a failure. They started at $15 a ton. That was their expectation of financial markets. The CDMs went down to 30 cents a ton because of the crash after 2008, making that place a failure. There's a failure in all sorts of other ways, which you can look at the Salgo report. I don't know, I rest my case. The way to get this problem of lack of finance under control is to put corporates at a higher tax with prescribed assets and exchange controls. There's a phrase for it we use in academic language, financial repression, and it's long overdue.
Thanks, Patrick. Unfortunately, I've been getting signals that we need to wrap it up. I feel like we've only just got started, so it's quite unfortunate. I think this is indeed a meaty and all-encompassing topic. So thanks all of you for joining us. I'm really sorry Sinagugu couldn't make it, but I'm hoping we can get some response from him. And thank you, Dean, thank you, Kate, thank you, Patrick, for your time and some very thought-provoking discussions. Much appreciated.
Thank you very much to Brandon Abitner for that amazing panel discussion. Indeed, time is not on our side, and yet it was so packed, so insightful, and there was more to be spoken about. I don't want to take up much time, but I hope you've taken down notes around some of the inputs that were offered by our concerned. So thank you very much for that. We are going to move swiftly, but before we do, let I remind you to please visit our 3D Expo exhibition, ask questions, engage, and do add your comments and your questions on our social media handles, SAS Summit 2020, SAS Summit 2020. Just check that out. We are streaming also on YouTube, so you're more than welcome to catch up on that platform.